as much as I haven't got huge respect for academics, I really wanted to share with you this interview with former RBA board member and economist, Professor Warwick McKibbin. Again, he's a professor, he's a former board member of Reserve Bank of Australia, so it doesn't sound like he's got a real life experience running businesses, working in the private sector, but this is a great interview and I really wanted to share it with you. Enjoy.
A leading economist argues the Reserve Bank should have raised rates 12 months ago, and the longer it waits, the worse it will be for the economy when it does. Former RBA board member and economist Professor Warwick McKibbin says Australia is being left exposed to external shocks, with rates remaining at 1.5%. Professor McKibbin, a world-leading monetary policy academic, joined me in Sydney. Warwick McKibbin, you're arguing that the Reserve Bank should just go ahead and lift rates now. What are the arguments for doing that?
So the question is, where should interest rates be today, not how much should they change? And if you look at just about every indicator, nominal growth, employment, everything is suggesting interest rates should be probably moving up with the US. In Australia, the mandate of the bank is inflation targeting, and inflation is just at the bottom of the range, and that's what prevents them from raising rates. The problem I have with that is that we've had ultra-loose monetary policy for a long time, and it's created all sorts of misallocation of credit within the economy, potentially. A lot of people have over-leveraged, corporates, households, and raising rates 25 basis points would be a good test of how robust the system is. It would readjust people's expectations about whether or not they should go out and speculate on property, and it would, if it was delivered with a very clear argument as to why rates were going up, it would actually strengthen the economy and strengthen people's understanding of where the economy is heading.
We've already got the property market easing in an orderly fashion. We've got record levels of household debt. We've potentially got an election coming up in the next couple of months. Is now the time to shock the economy a little bit with an interest rate rise?
Well, actually,
yeah, well, all right. I wasn't going to stop this and make any comments, but in an orderly fashion is what it seems to be that the property market is behaving at the moment. What I think we're doing on this channel is documenting the property market collapse. I think it'll be one of the biggest bubble bursts. I don't like using that word, but I have used it a lot. It doesn't look like anything else but a bubble. So it will be the biggest one. It only seems like an orderly pullback right now. It won't seem that way when it goes down 40-50%, in my humble opinion. All right, I'll shut up now and let you watch this great interview.
12 months ago was the time to do it, and the longer you leave it, the more problems you're going to have. And you can always make an argument as to why you shouldn't increase interest rates. This happened in the mid-2000s when I was on the board, and we did raise interest rates, and we left them until we had to raise them, and that was just before the election when John Howard was Prime Minister. That was very unpopular, but necessary. And I think the key role here of the central bank is they can't solve all of the economy's problems, and certainly raising 25 basis points, if that's deemed to be a shock to the economy, then we're in pretty bad shape. I don't think we are. I think we're in pretty good shape. We need to renormalise the financial markets so that people can make decisions, long-term decisions, having a clear view of where the economy's heading and what's the cost of money.
What's the downside to leaving them where they are? The Reserve Bank argues that, things are trucking along quite well. You have wage inflation gradually winding up. You've got inflation itself gradually winding up. We're now at 2.1%, which is inside their target. You have unemployment gradually coming down. Why just wade into that and sort of, throw it all up in the air?
Well, again, I don't think it's that disruptive, but think of the broader context. We live in a world where the world long-term interest rate is driven by outside powers. Long-term interest rates around the world are rising. Short-term interest rates around the world are rising. We can't sit here and expect that our interest rates will be unaffected by world developments. Now, we know that we're now below the US interest rate. We also know that long-term rates are rising. We know that the cost of offshore funding of our banks is rising. And we know that the response to that is that banks are starting to raise interest rates outside of the control of the Reserve Bank policy cycle. So in a sense, the danger is that we have the market adjusting and the central bank is left behind the curve. And if the more the market does the adjustment, the harder it is for the central bank to make the argument that they're controlling the price of money in the short term. And I think that unhinging of monetary policy is actually a problem.
We have yet to see the big four move their rates high, but we've seen a lot of the smaller lenders already shift up by around 15 basis points. Now, that's not enough to scare the horses. What do you think would be the impact if you're going to see the banks continue to raise as offshore funding goes up, and then stick an official interest rate rise on top of that? Would it, do you think, decrease the bank's need to raise out of cycle? Does it fundamentally shift their funding costs?
No, it doesn't, but it means that the central bank has a very clear view of where interest rates are going in the economy and is controlling that movement. I think actually it's not just a question of raising rates. I think we actually need a different monetary framework, and I think what's holding the bank back is this inflation targeting framework. It's also why wage earners aren't pushing for higher wages, because they know the central bank will react if inflation starts to rise. You need to target something like nominal GDP growth or nominal income growth, because that's really what matters in the longer term, and that's the big driver of stability in a world that's highly leveraged. So I think ideally you'd change both the framework a little bit, and then you'd start raising rates, which are consistent with the new framework, because our nominal growth in the economy is running well above 1.5%, which means that we have quite loose monetary policy.
The chances of that framework being changed are surely slim to none.
Well, the typical response when I raise this, and I've been raising this actually for about 20 years, is that if it ain't broke, don't fix it. And they had the same argument in the late 80s when I worked at the bank. If it ain't broke, don't fix it. And then it broke in 1991 when the recession we didn't have to have was enforced on the economy because we had the wrong monetary framework. We were targeting the current account, we were raising interest rates to 21%, and yes, it caused a deep recession. So the best time to set up your monetary framework is actually in a period of stability, when you move from a system that's working okay to a system that's going to work much better in the world in which we're about to enter.
Company tax cuts look like they could be off the table, or at least they're quite threatened as a result of the elections that we've had over the weekend. Would that be any great deal if they were taken off the table?
Well, again, the corporate tax cuts are a good idea for the Australian economy. They're not as good as a lot of people think, because some of the benefits that you get from the corporate tax cuts don't actually increase Australia's income. It'll increase Australia's production, and some of that income will flow overseas. But it is still an important part of a comprehensive tax package. I think corporate tax cuts by themselves is another little adjustment, but you need comprehensive tax reform, and that's when I think you bring in the corporate tax cuts, because you need to get all the various changes in the tax system to move in the right direction together, and that's a way of trading off winners and losers. But isolated tax cuts, politically, that's not my area that I worry about, but economically, they're good for the economy, but they'd be much better if they were part of a comprehensive tax reform package. Delaying them is probably going to have a very small impact on the economy relative to some of the other shocks that are out there that you could see coming out of the US, Europe or Asia.
You've just done a tour from one end of Europe to the other and then over to the US. How are those economies looking?
Well, Europe's interesting because they're trying to defend a monetary system which is not designed for purpose. We have parts of Europe, Greece in particular, but even Italy, where we've had a complete turnover of the political status quo. People are not doing well inside the Eurozone. There's a lot of instability. It's been held together by a strong Germany, and that's a good sign. But the rest of Europe really does need to have a devaluation, and they can't do that while they're in the Eurozone. So the politics of that still means that there's a lot of unanswered problems inside the Eurozone. While Germany grows, that's great, but that also puts pressure on the rest of Europe. The whole issue of immigration is a big deal as part of that whole process of asymmetric shocks. Can economies absorb all those people and still have a fixed exchange rate with Germany? These sorts of questions. And the big concern, of course, is Donald Trump and the potential for a trade war with Europe, which looks like it's been averted. But then even a trade war with China, from a European perspective, a US trade war with China creates all sorts of uncertainty and all sorts of new risks in the global economy.
Before we get to China and America, what about Brexit in Europe? Is that seen as a big economic deal?
It is a big deal. The surprising thing about Brexit is that the British economy hasn't gone into a deep recession already. A lot of people forecasted it. I forecast it. My model suggested that would happen. It hasn't happened yet, and it's seen as a linchpin of the debate within Europe. If the UK can pull out of the European Union and successfully do so, then that could encourage other parts of Europe to also pull out of not just the European Union, but also the Eurozone, which is, I think, the bigger problem. The problem's not with the European Union, it's with a fixed exchange rate in the Eurozone.
Over across the Atlantic to the US with Donald Trump, potential trade wars. We saw a huge GDP print from the US just last week. Do you think that that can continue?
What's interesting is we modelled Donald Trump's policies when he won the election at the very beginning of the Trump administration, and we went through what he promised in his election campaign and what we thought he might do. So we modelled immigration, we modelled the fiscal stimulus, tax cuts, infrastructure increases, defence spending, we modelled trade war. And what's interesting with the fiscal side of the Trump package is it leads to an enormous expansion of the US economy that's quite temporary. So by our estimates, probably the US would grow by about 4.5% for about a year. And interestingly, that growth is sustained for a couple of years, and then eventually it causes a very large increase in debt, probably a doubling of government debt over 20 years, and that causes a big slowdown in about 8 years' time in the US. The problem with that is that the politics of having a strong economy is overwhelmingly in support of Donald Trump, even though the policies themselves, not only do they take the future wealth of Americans and let the current generation spend it, they also cause an enormous amount of capital to have to come into the country to finance the deficit, and in doing so drive up the US dollar, and in doing so worsen the US trade balance by about 5% of GDP, and that leads to overwhelmingly an argument for why you want to have a trade war. And so his policies are pushing in the one direction, and that is a major showdown in the global economy, particularly high risk for the global financial system.
The Reserve Bank Governor Philip Lowe sees China as the biggest threat to Australia. Do you agree?
Are you talking economic or political?
Economic.
So I don't agree with that. I think the biggest threat to Australia is not Donald Trump levying tariffs on Australia, but Donald Trump causing the global financial system and the global trading system to unravel. Destroying institutions like the World Trade Organization is far more damaging to Australia's self-interest than anything that China could do. I'm quite positive about the economic situation in China. There's a lot of political hurdles and a lot of interesting questions that political scientists can deal with. But in terms of the robustness of the economy, the use of market mechanisms to get economic growth, driving growth out with fundamentals like education, like investment, like a whole range of removing distortions in the economy, even the Belt Road Initiative, from an economic point of view, is a very sound policy. The politics of that is very, very frightening in a sense, because the Chinese have moved towards a more Marxist state, and actually outwardly so, trying to influence global philosophies. But in terms of economics, I think China can do quite well for a long time, dealing with, of course, the problem of their demographic transition, which will inevitably slow them down from 6.8% to 5% after a decade. So I think from Australia's point of view, that's not our biggest concern. Our biggest concern is right now what the US president might do to the driver of Australia's growth, one of the key drivers, which is international trade.
So what do you think the likeliness is that the Trump administration could deliver an economic shock to Australia?
It's not trivial, in fact, because we see with President Trump, he's always doubling down. So the tariffs on China have all of a sudden gone from 150 billion to 500 billion worth of goods. And this sort of unknown responses to various provocations is really quite dangerous from a risk point of view. And risk is bad for growth. Risk is bad for countries that have a lot of debt, because risk can be priced, and then all of a sudden you have a financial problem at your door.
Warwick McKibbin, thanks so much for your time.
Happy to be here, Lise.
All right, I can't say I agree on everything said, but then again, who am I? I've got a day job. This guy's day job is to predict economic future. I think they normally fail, but it is what it is. I hope you enjoyed it. I'm about to create another video after this, so stay tuned. Thank you.